Okay, well, thank you so much. I hope you can all hear me over there. I'm sitting here in Valley Forge, Pennsylvania, and I'm not able to do a trip to London just for this occasion, but I kind of wish I was there. We've made many trips to Europe and the United Kingdom and enjoyed every second of it. So in a lot of ways, I envy you. Let me first, if I may respectfully disagree with my introducer. I don't think that indexing is a kind of pendulum that's going to swing back and forth. I think indexing is part of a secular trend that is just going to go up and up and up. It's going to slow down a lot in its rate of growth. That's what always happens when you have growth at these levels, and I have no doubt about that. But it's as if, to give you a kind of more conventional, maybe real-world example, these smartphones, they're not going to be less smartphones 10 years from now than there are today. They're going to be more of them and more sophisticated and all that kind of thing. And indexing is on that kind of track. Not that it will grow, again, to emphasize this, at that speed, but it's not something, index is not going to go backward at all. I think that's the case. We never know. You can easily worry, as I do, when you think about these cash flows in indexing and out of active management. And the numbers we use here is in the last decade, about 1.7 in U.S. About 1.7 trillion has gone in index funds, and about 1.0 trillion has come out of actively managed funds. That's a $2.7 trillion swing in investor preferences, the likes of which have never been seen before. So it's an index revolution, and it's being led by Vanguard, of course, because we are the factor that's very big, 80% of the market in traditional index funds, and around 30% of the market in exchange-traded funds. So I want to show you the chart you now see shows you the tremendous growth in the early years of the ETFs, of course, and but looks remarkably stable for about the last 7 years. In other words, the growth in traditional index funds and the growth in exchange-traded funds have been just about the same, as you can see there, and now they're very close to the same in size. There does seem to be this year quite a spurt in traditional exchange-traded funds, and I don't know quite why, because I haven't seen where the cash is going, but exchange-traded funds are going to be very, very important in this equation. I have a big caution about exchange-traded funds, and that is I've always been wary of any new investment instrument that has not yet been tested under the pressures of the marketplace. We've had pretty benign markets. Nobody can really tell you. We can speculate a little bit about what happened on a few bad occasions, but nobody really knows what would happen if there was real disturbance in the market. How would it affect ETFs? And for that matter, how would it affect traditional index funds? Because this money is flowed out of actively managed funds and into index funds means that money is coming into index funds at very, very high levels of the market. And I do a little work on this subject and try and forecast future returns, or at least reasonable expectations for future returns. And in the era in which the index fund has grown, going back to '82, when it really began to grow as rapidly, and in percentage terms anyway, and to date, the S&P 500 has given us 12% a year. I mean, it's a remarkable, unbelievable return. And I think if we get 4% a year in the future, say the next decade, I don't do short-term forecasts, it'll be interesting to see how investors get tested in that kind of a marketplace. And those numbers are not casual numbers. I mean, I do it with a sort of systematic way. You know, in the long period, the '82 to date period, the dividend yield has averaged probably 5%. And the dividend yield is now 2%. Earnings growth has averaged about 5.5% in that period. I don't think we'll do that well in the future, although I don't know. I'd say maybe 4. And then this market started with a price-earning multiple of 7. And now by my reckoning, that is past GAAP earnings, past reported earnings, using that as for the PE, not future operating earnings, as so many people use. I'm looking at about a 24 times PE, up from 7. So you can only get so much, for the want of a better expression, blood out of a turnip. But here indexers going, they're going because it's the only way for TIFs, traditional index funds. And by the way, I hope someone will be help me in making TIF part of the language as ETF has become, because it's kind of isolated and no one even talks about it because it's never had a name. That's a problem. So it's in any event, the growth is very good in both, but they're very, very different. And if you want to go to the next slide, this will just give you some idea of the asset mix and the number of funds in mix. And the significant difference is that 80% of TIF assets are invested in core asset classes, diversified U.S., diversified non-U.S., and diversified bonds, versus only 46%, only a little over half as much in ETFs. ETFs have a very heavy speculative component. You'll see it over there on the right. 22% of the funds, that turns out to be, well, I'll have to do the math in my head too, some 300 to 400 funds in the speculative category. They're selling leverage. And I'm not just particularly smitten with the idea that it's a public good to allow investors to bet in the stock market every day. Is it going up or is it going down? And if you bet right, you get a payoff of 3 times. That has nothing to do with what investing and long-term investing is about. It's all about short-term speculation. And I think we all know from the data that the more people trade, the more they speculate, investors I'm speaking of here, the worse they do. And so active trading turns out to be, by definition, the future, a loser's game, because we all divide up the market return, another one of my ways of looking at things, and the average investor, the average of all investors, turns out to get the return of the market. And when you deduct cost, owning the stock market becomes a loser's game for everybody as a group. There's just no way around that. So the two businesses are quite different, and I think a separation of them in the minds of analysts of this industry, in the minds of investors, is very, very important. So we'll go over now to the next one about large ETF providers, and we've left off here because we're only talking about ETFs here, the traditional index funds, which Vanguard has around 2.2 trillion. So Vanguard, if you look at that list, iShares is about $1 trillion in ETFs and index funds total. They have no traditional index funds. Vanguard, with 2.2 trillion of traditional index funds, would be 2.8 trillion, by far the dominant force in total index assets. And State Street Global, very, very limited, has no traditional index funds, another 5. That's a lot of concentration in 3 firms. A number of good papers have been presented about it, and it's worth thinking about the consequences of that. In the U.S., as you probably know, our Investment Company Act, which is weird because it applies to funds and not to fund complexes. It was done so long ago, everybody had one fund, or at least most firms had one fund in 1940. And now there are fund complexes, but it says that no fund, with respect to 75% of its assets, no fund can own more than 10% of the voting securities of any one company. Well, that's a pretty weak protection, because if you get to 10%, you can just start a second index fund. It would be as simple as that in this abstract example. So we have 3 index funds, actually. So the 10% we'll never get to. But we might get to 10%. We'll probably get to 10%. And whether regulators will overlook that, or whether, as the introduction said, we become significant financial institutions carrying certain risks to the marketplace, I think is something we all ought to be very, very careful about. So we look there and look at the turnover rates of those ETFs. You can see Vanguard only has a 193% turnover rate. I say only as kind of a joke, because I think 3% turnover is kind of pushing the envelope. And our funds are extremely low there, 193%. The iShares goes 600% plus, and State Street Global, largely the spider, goes to almost 2,000% a year. Now, the spider, as you probably all know, every day is the most widely traded stock in the world. Usually about $20 billion a day. It varies quite a bit under market circumstances, but say between $15 billion and $25 billion every single day. And that turns out to be institutions trading with one another. If you look at the top 10 holders of the iShares 500, the Vanguard 500, and State Street Global Spider, they're all pretty much the same institutions, financial institutions, banks, and others who are trading with each other every day. And the one thing you realize in this world is when people are trading with one another, both sides don't make a profit. That would be very rare, or if not impossible. And the brokers in the middle do. And partly as a result of this, I think people are not aware of this at all, most people, and that is ETFs, the 100 largest ETFs compared to the 100 largest equity funds are turning over, or accounting for, the ETFs are accounting for 35% to 40% of the volume that we get here in the U.S. Every day. And it's a huge percentage of the volume in these traded ETFs, which turn at a much higher rate, as you can see in this chart. The ETFs can turn over as high as, on an average of 1,800% a year, where the 100 largest stocks, these are the old trading instruments, turn over at 1/10 that rate, 184%. So, and very stable over time. And the ETFs go right through the roof. That 208, 207, 208 is, I think, the result of a lot of trading going on when the market started to reach for its lows. It hit them in 2009, and this is probably about that time. So they're part of ETFs are part of the trading environment, and much more aggressive than we've ever seen before. One interesting thing, and I was stunned. I don't stun so easily, but I was stunned when I saw this next chart, and that is, if you want to put the next chart up, please. Can we get the next chart up? Click, click. Can we do something? Oh, there we go. That in a severe down market, I just looked at the severe down market from October of 2007 to February of 2009, and then we looked at a couple extra months through April of 2009. And if you look carefully, and you have to look carefully, the TIF net cash flow, it just rambles along almost the same month after month after month. It's absolutely amazing. And I guess they're quarters, actually, but quarter after quarter. And you can see those little tan things down at the bottom, those little tan marks, orangey tan, whatever you want to call it. And there's not a single negative quarter. I guess they're months. Sorry about that. And look at the fluctuation in ETF volume. They take in $30 billion in a month. They lose $12 billion. And then when you move over to the other side, as the market starts going down and reaching toward a low, it's going down quite a bit. And you'll see that tall blue stack there over toward the right center. Looks like 40 billion going in. And then as the market recovers, it looks like we lose about 20 billion going out. So tremendous volatility in ETF flows and unbelievably stable. I mean, I was so surprised. I mean, I knew these these traditional index fund holders of the Vanguard funds particularly were long-term in focus. But they seem, if you look carefully at this chart, to be totally unrattled by this great 50% market decline. So I think that's a source of stability, and how they would react. And this time, the next time we had a 50% decline, I do not know. But so far, it looks pretty good. Now, let's go to the next chart and see how all this trading does with these investors. And we tried to do a little cash flow analysis of the investor returns versus the returns by the S&P 500 index itself. and or in the two funds. And you'll see that the Spider ETF had a 6.8%, 6.9% return, let's say, and the Vanguard S&P 500 regular fund had a 6.9% return. The investors, however, in the Spider didn't earn 6.9%. They earned 4.3%. They were adding to their holdings of the Spider at high levels and reducing them at low levels. So the investors lagged the return of the Spider by 2.5% a year. That's huge over time. You know that. And with the S&P 500, that's almost rounding errors. 6.9% fund, 6.4% investor, a lag of 0.5%. So a lot of evidence that this trading, again and again, trading doesn't seem to pay off very well for investors. Now let me just mention another significant thing that going on here, pretty important, and this is my last slide. Smart beta is the big new thing. There's a pendulum for you, and it's been very, very popular. I think, Morningstar calls it strategic beta, and I think there are probably 100 strategic beta funds out there. And how are they doing? How is the RAFI fund doing, the original fundamental fund? How is Wisdom Tree doing? Jeremy Siegel's dividend-based, purely dividend-based, weighted by the aggregate dividends that the funds, that the securities have. And RAFI is weighted by a number of factors, including dividends, book values, I think maybe even number of employees, things of that nature, more fundamental things. And the claim was when they came out 9 and 10 years ago that they, particularly Professor Siegel, said he was the new Copernicus. He was reordering the universe. Well, as you can see from this chart, that claim may be a little over the top. In the case of RAFI, you'll see right there, yes, they did have a slightly higher return than the Vanguard 500 ETF, 8.7% compared to 8.1%. But they also took a higher risk, had a higher volatility, and so the return dropped to 7.8% risk-adjusted compared to 8.3% for the Vanguard 500. So the 500 ETF had a higher Sharpe ratio, just sort of the same as the risk-adjusted ratio, just a different number. And remarkably, the two funds have this tremendous parallel. The RAFI has 94%, as you see at the bottom there, of its return explained by the S&P 500. And when you go over to Jeremy Siegel, that's a year less of time, just exactly the opposite of the RAFI, and that is a slightly lower yield than the S&P 500. But risk-adjusted, they took a lower risk. They come back a little bit, but still have a lower return, 8.1% risk-adjusted than 8.4%, or again, the same thing in Sharpe ratio terms. So smart beta is, Professor William Sharpe calls smart beta stupid. And, I guess I wouldn't quite say it was stupid. It just makes claims that are beyond its ability to fulfill. Similar portfolios with different weights using the same stocks are not apt to be very different in the long run. Now, this is a 10-year test. We'll look at it again and again and again and see if this holds up. But I'm not so good on panaceas. I'm not so good at niche investing. I don't like the idea of investing in individual countries. When you look at the panoply of ETFs out there, it's really quite amazing how many choices you have. There are 2,000 of them, or almost 2,000 of them, most of which make their own indexes. And so the vast majority, in fact, make their own indexes. So investors are going to have to learn from experience. Are ETFs the answer? Will they certainly give an investor a chance to exercise his gambling instincts. But in the long run, I would warn everybody that sometimes, maybe very often, great marketing ideas are not great investment ideas. So with that, I think I'll close my remarks, and hope we can have some debate on this when we get a little question and answer period.
Thank you, Jack. With that, turn it over to Ananth.
Okay, thank you, Stan, and thank you to my colleagues at LBS and AQR for inviting me and for enabling us to have this great debate. Let me just start off with some facts about the ETF growth, and then let me put my perspective on what we've seen and make some comments about the earlier session about macroprudential risks and the growth of index investing, particularly in the form of ETFs. So this is my version of a chart you just saw from Mr. Bogle. So this is the growth in the US and outside the US in mutual fund flows. So these are cumulative flows. And the big story is, of course, the growth of index and ETF assets, shown in gray at the bottom, and the decline in traditional active equity assets. You also see here in this chart the rise of factors and, interestingly, the rise of active fixed income, which I'll comment upon in more detail towards the end of the talk. So we understand the background. What's driving it? Why is the ETF construct or mechanism or investment vehicle so popular? Why is it become from pretty much nowhere? Remember, the first ETF was only launched in 1994. Today, globally, we're at $3.5, $3.8 trillion in ETF assets. So it's amazing when you think about it over those years. What's driving that success of ETFs? Why are so many people using them? The answer is that ETFs combine elements of stocks and mutual funds. So like a security, they offer price transparency. They're traded in real time on public markets. There is a very important element of secondary liquidity. And by that, I mean non-intermediated liquidity. And we'll touch upon that and the difference from traditional mutual funds in a second. Simplicity, it trades on an exchange like a stock. It is also an investment tool. So most of these ETFs seek to track benchmark indices, and most of the assets in ETFs today are against popular, widely known indices like the S&P 500 or EFA. The success of ETFs is partly because of the transparency and the ease of trading, but also it's about cost. These are very low-cost vehicles to gain exposures and a variety of exposures, regions, countries, sectors, broad indices, etc. There's a tremendous amount of choice out there for investors. I think the key point that is relevant, especially from the macroprudential part of the discussion earlier, is that unlike traditional mutual funds, creations and redemptions in an ETF typically do not require the fund to interact with the market. So if there is a large-scale redemption of an index fund, the fund manager has to raise the cash and will do so by selling securities. In the ETF, however, because of the secondary nature of trading, typically there will be an exchange of securities that are going on between buyers and sellers at a market-determined price. And that part is going to be relevant when we talk about ETFs in times of stress. So I'm going to follow on from where Mr. Bogle is leading and sort of talk through what happens in times of market stress, at least in our memory. All right? And before I do that, let me just talk a little bit about, are ETFs too big? I think you want to start with the chart on the right, put it in perspective. $3.8 trillion globally, so these are all in trillions of dollars, but tiny compared to the scope of the potential market in terms of global mutual funds, in terms of products that give you broad exposures like futures and swaps, and of individual securities. Okay? On the left, and this will answer a little bit of some of the high turnover numbers that Mr. Bogle referred to, is why is it so popular? Well, clients can choose among different financial instruments, and clients are often choosing ETFs as a substitute of one of these four instruments that are shown there. Obviously, they may replace single security holdings with an ETF. Cheaper, easier, more diversification. They may find it cheaper to trade ETFs versus traditional futures. Futures, we all know in this group, I think particularly, know that futures contracts are quite cheap to trade, but there are roll costs. When you roll those futures contracts month after month or quarter after quarter, those costs can add up. And again, with an ETF, the costs and the components of the fund are relatively transparent, and therefore increasingly we're seeing sophisticated financial institutions use ETFs instead of futures contracts or in lieu of futures contracts to gain exposures, to hedge risk, to do other things. Of course, ETFs compete with index funds in separate accounts. And then they're also, and this is getting to the point about factor-based investing or smart beta, they're competing with active low-value index funds, closet indexers, and what I'll call factor huggers. These are managers who charge relatively high fees but sit on factors like value or low volatility, factors that ETFs can deliver at extremely low cost. So multiple sources of interest in a common vehicle, that's what drives some of the high turnover numbers that you see relative to traditional index funds. So I'll use the TIF acronym there. Relative to traditional index funds, these products are used by many other kinds of investors. And I'm not trying to say, I really want to be clear, I'm not trying to say that one is better than the other. So, you know, if someone is a investor and they don't want a brokerage account and they don't want to deal with trading, they don't want to deal with commissions, and they'd rather send a check every month to Vanguard or to another index fund provider, the index mutual fund is a great choice for them. If they really are a 20-year horizon kind of person, that's great. If you have a brokerage account, you're comfortable trading, ETFs may be better, and the tax situation may favor an ETF. So there are choices. That's what the financial markets are all about. They offer choices, and investors like the choice. If I look at my own personal portfolio, if you look inside that, there are a lot of ETFs, a lot of BlackRock ETFs. There are also ETFs from other providers. There are index mutual funds in my portfolio. Why? For the complicated reasons. They have to do with taxes, with where I was working at the time. Stan went through an abbreviated version of my employment history, but he forgot the New York Stock Exchange, and there were a few other places. So stuff accumulates. You get older, and you have all these things, and you know, it's not like one is better. They're all different choices, and I personally use them all. And you know, I've thought carefully about what I'm doing and why I'm doing it. Let's get to fixed income, because this is where the big growth in ETFs is taking place. And if you take away anything from my talk, it is that there is actually a revolution going on in fixed income. So I think of ETFs as a disruptive financial technology. They're disruptive because they enable access to exposures at low cost, exposures that previously most investors, especially retail investors, could only gain at high cost or couldn't gain access to at all, like emerging markets. They'd have to pay a hedge fund manager to gain plain vanilla exposure to emerging markets. So particularly on the fixed income side, we're on the cusp of a revolution. So the fixed income markets are sort of characterized by opacity. So there's a lack of transparency. It's largely an over-the-counter market with sort of very murky pricing, very difficult to understand the true transaction costs in bonds. These are not lit markets. By contrast, bond ETFs are diversified portfolios. They trade in lit exchanges, meaning there's a lot of pre-trade transparency, post-trade reporting. You can see what's going on, and you can look inside these portfolios and you understand what's going on, and you see that they are providing investors with diversification at relatively low cost compared to the underlying stocks and bonds. And the point of this chart is to really show you that whether we're looking at the US or Europe, and I'm sorry, I should have added the Union Jack there too at the bottom. But whether we're looking, trust me, the UK is in there. But whether we're looking at the US or Europe, in both equity and in fixed income space, ETFs are not as dominant as you think. All right, they are less than 8% of US equities, less than 1% of US fixed income. It's even more stark in Europe. So there's tremendous opportunities to grow and extend this innovation to the fixed income markets. And moving on a little bit, let me talk about what's the impact. So tying this discussion back to the first part of the conference, we had a really distinguished panel talking about some of the risks that were out there and some of the things that we need to think about from a regulatory viewpoint. And a natural question to ask is, what happens in times of stress? So the word stress and stress test came up a lot in the earlier session. And we wanted to see what would happen, what happens to these ETFs during times of stress. And so, we don't have a tremendous amount of history, but I'd say we've gone through several crises that are listed here. The credit crisis, the sovereign debt crisis in Europe, the Treasury downgrade in 2011, the so-called taper tantrum when Ben Bernanke seemed to suggest that interest rates were on the rise in 2013, the oil sell-off. There was even a minor sell-off at the end of 2015. What do we see? What is the common thread? Well, what you see is that actually, if you look at high-yield ETFs and investment-grade ETFs, what you see is typically in these stress markets, higher volumes of the ETFs. You do see discounts to NAV, to the net asset value of the funds. Often that's because the ETF is leading in price discovery, and we have a lot of academic research to show that. There is no forced selling because of the mechanism I talked to earlier, where buyers and sellers are trading with each other at market-determined prices, and that actually doesn't spill over into the underlying markets. And so what you see in the chart at the bottom is those episodes. The blue line shows the volumes on the exchange, and I'll get to the point about ETFs being 35% of dollar volume is in a second. You get to the volumes on the exchange, and they spike when you have these crises. But the green line at the bottom is the actual creation-redemption activity in the so-called primary market. This is actually the net trading by the owners of these ETFs, whether they're redeeming or creating these ETFs. And you see very little activity there relative to the activity in the secondary market. So the ETF secondary market layer of liquidity that I talked about is actually a buffer. It's a safety valve. And the reason for that is because the ETF is at least as liquid as the underlying assets. If there was no liquidity whatsoever in the secondary market, nobody was buying or selling the ETF, to create an ETF, you would buy up the shares of the underlying basket of bonds or stocks, deliver it to Vanguard or to State Street or to BlackRock, and you'd get back a shiny new ETF. If you wanted to do that in reverse, you'd give them back the ETF, perhaps slightly tainted now, you'd get back your underlying securities. It's an in-kind transfer for the most part. And therefore, you don't see the forced selling. You don't see the spillover that you would. And that's important because when we actually talk in more detail about some of these episodes, this is my penultimate slide. If you look at US high-yield ETF trading, you'll see typically the secondary market layer of liquidity, which is incremental, because you can always just buy the assets and deliver them or get the assets back, which is purely incremental. The ratio of secondary market trading to actual creation or redemption is about 6 to 1. So yes, it is true that ETFs are about a third of dollar trading volumes, sometimes 40% of dollar trading volumes on highly volatile days. But trading of individuals in the ETF does not represent trading by the ETF managers themselves. These are typically, ETFs are typically tracking benchmark index funds with low turnover. Okay, so people are using the ETFs as vehicles for price discovery. They're using them to lay off risk. These are all buffers. And what we see is this ratio of secondary market trading to primary market trading actually spikes in these crises. Okay, and I won't go through the chart in detail. And I do want to get to my last slide, which is to go through some of the myth-busting arguments about index markets in general. And these aren't particular to ETFs. These are more about indexing. And I'll tie it back to Stan's question about what are the natural limits of the rise of indexing. So one comment, obviously, is that, hey, ETFs reduce price discovery. They're so large. As passive grows, price discovery gets impaired. Everybody just wants to look like the market. I will just say to you that I don't think that that's how markets work. We will reach an equilibrium. Mr. Bogle's absolutely right. We will reach an equilibrium. In that equilibrium, if ETFs and other passive investors, including traditional index funds, are dominating markets and are somehow distorting markets, which is hard because they are representing the markets, but if they are somehow distorting the markets, that's an opportunity for active managers. Okay, you can do a thought experiment. Imagine a world with 100% passive. Well, if I'm an active manager, I would love to start my own hedge fund. All I need to do is predict which stocks are going to be added to the index and which stocks are going to be deleted from the index, and I would make a fortune. So we can't be at 100%. We can't be at 0% either, because then there are tremendous incentives to create an automated fund that just free rides off the price discovery of managers. So somewhere in between is an equilibrium. And I will take issue with sort of this idea that somehow there's a reduction in the liquidity of the underlying assets as a result of the ETFs. ETFs are offered diversified portfolios in lieu of the underlying securities. And what we've seen is that actually the point I wanted to make about security trading and the secondary market is that it is a source of price discovery and a source of laying off liquidity risk through non-intermediated trading that does not actually spill over into the underlying markets. Okay. The other point about ETFs is they actually do contribute to price discovery. If a hedge fund were to short, let's say, a financial sector ETF and buy a a technology ETF, that's a long-short position that has an impact on the underlying securities. Okay, it contributes to price discovery of financials versus technology. Okay, so the point that I'd like to end with is also about the governance question. So Mr. Bogle alluded to the concentration from common owners. I would just say that I don't think we're at those thresholds. We are asset managers, so we represent the client's best interests. We don't actually control these assets. We are trying to track indices for the most part through the ETFs. So we will faithfully track those indices irrespective of the market volatility. So let me end there and just say that in conclusion, I don't think there's any fear that we're going to get to a world where passive is going to completely dominate the market. We will not. We will reach an equilibrium where passive and active coexist. And I will finally just say the last point is that all decisions to some extent are active. So even if you were to put your money into the index 500, that is an active decision. You're choosing to go for large cap US. You were saying, we're not investing in the rest of the world. We're not investing in mid cap stocks or small cap stocks. That is actually an active decision. So all decisions at the end of the day made by investors are somewhat active. And they need to be because every investor is different in terms of risk aversion, in terms of their tax situation, in terms of all the rest. So we need to optimally blend all of these elements. And that's what this is all about. This is all about offering choice so that investors can actually make reasoned decisions about where they want to stand in the market. So let me stop there, and then we can move on to questions. Thank you.
Okay, thanks, Ananth. So with that, I would like to open the floor for questions. So if you have a question, can you state your name and affiliation, and also who the question is directed to, whether it's directed to C Bogle or Ananth.
Or the regulators.
Or the regulators who are still in the room.
This is for the regulators.
Then we can make sure that the right person answers the question.
This is a question for Mr. Bogle. The Random Walk, the book was written in 1973, and Professor Ross's arbitrage pricing theory was in the 70s. Yeah, you have a skepticism about innovation. Where do you want to see reform and innovation focused on these days?
I'm sorry, could you repeat that for me, please?
Where do you want to see reform and innovation focused on these days?
Well, this is going to sound funny to you because I have some record of innovation myself. But I wonder if we aren't suffering in the financial business from too much innovation. How many of these innovations are innovations that are designed to make life better for the investor? And how much of these innovations are there to make life better for the marketers? New products to sell. We've got to sell some new products because we've got a lot of salesmen out there. We better find something new and hope it's hot. The latter kind of innovation, I may have tipped my hand a little bit on this, just does absolutely nothing for me. I look back and I loved an ad by the Shredded Wheat Company about 7 or 8 years ago, 5 or 6 years ago. And it said, "This is the shredded wheat biscuit." All it had on the page was a little text and a picture of the shredded wheat biscuit. And it says, "This is the shredded wheat biscuit. It is made with the same machinery, the same care, and the same ingredients as it was when we first started making it 100 years ago." We have put the "no" back in innovation. And I like that. I think we in the industry, in the financial business, ought to think for whom we are innovating. New products, as we call them, and come and go. And new funds come and go. You know, the recent Standard & Poor's report shows that 40% of mutual funds go out of business every 15 years. 40%, just think about that. And when you get into how often they change managers, which is about every 8 years, you wonder what you've got to hang your hat on. So for me, I go back to, it's a little bit long. I mean, my answer is a little bit long, but I want to have a chance to state my basic fundamental principle. What is the core idea of equity investing? And the answer is to invest for a lifetime and achieve a sufficient fund to retire with. An investor 35 is going to be investing for at least 50 years till he's 85, and I've already passed my 85 by a couple of years, still hanging in. And so what is the chance? So he buys the S&P and holds it for 50 years. What is the chance that another investor in ETFs, moving money back and forth, taxable when he makes all these trades, if he's done well, using misjudgments some of the time, at least some of the time, maybe half of the time if he's lucky, what is the chance that an investor who's trading ETFs will do better than the investor who buys and holds, let's say, the U.S. stock market, although the S&P is a very good representation of it, or the world stock market for that matter? And I think the chances, I'm going to be very cautious with my answer here, I think the chances are 0.
Okay, that's a pretty strong statement.
Did I make myself clear?
Yes, loud and clear. Thank you for that answer. Any other questions in the room? There's a question in the back.
So this is for both of you, really. But Jack, I know you say you don't think that the market's being distorted, but there must come some point where company behavior changes because they're no longer have an incentive to compete with each other. M&A changes because the same people own the shares in both companies, and you would expect the behavior of chief executives to change, management teams to change, because the incentives imposed on them by shareholders change if index tracking is a large enough chunk so that they're in a, there is some point where that ought to happen. And so I'm interested both in at what point you think that might happen, and then slightly separately, smart beta, which imposes a whole bunch of different constraints that at some point, and active managers are now being pushed to do the same thing, but at some point chief executives, finance directors start seeing their own companies as a bundle of different factors, and managing them or pitching them to companies, pitching them to investors, structuring them in such a way that they fit neatly into the smart beta bucket. And obviously these are things that where it's the index having an effect back on the companies, which we really don't want to see. So I'm interested in if you worry about it at all, and if you don't, at what point you would, if at all.
Well, I've been around long enough to worry about pretty much everything. I used to tell our Vanguard staff, just when everything was going well, I'd say, what you don't realize is, in this room there is a great big giant. We can't see him, but he's there, and he's got a great big sledgehammer, and he is taking that sledgehammer back as I speak, and he's just about to hit me in the nape of the neck with that great big slug. And just because we don't see him doesn't mean he isn't there. And there are so many, we talk about, a la Donald Rumsfeld, the former Secretary of Defense in the U.S., he talks about, the known unknowns are troublesome, but even more troublesome are the unknown unknowns. So there's a lot going on out there. But as I look at our corporations, to get to the core, what I take to be the core of your question, will it change corporate behavior? And in my opinion, corporate behavior has changed, and in a very unfortunate way. That's one of the big risks, that corporations are going to cease to be what they were when they were in their heyday. And there was a wonderful article in the New York Times about 3 or 4 days ago about graduates of the Harvard Business School, the business school here in the U.S., and the article said that when you come into Harvard Business School, you believe that the job of the corporation is to provide goods and services that provide value to society. And when you leave Harvard Business School, you believe that the job of the business is to create shareholder value, whatever the heck that is, but usually it means price. I think that's an unfortunate trend. I think the huge merger trend that we've had going on cyclically for, I guess, 15 years at least, are all damaging to the interest of the investor in the long run. So I'm hoping and thinking a little bit positively about it, that there is a little rise here in the U.S. in the awareness and the involvement of large institutional investors, not just index funds, but of actively managed funds. And there's a group under the leadership of Jamie Dimon of the Morgan Bank that has a whole bunch of investors came together and worked out a set of governing principles. And, you know, they're not powerful at the moment. They're good. They've got to be more powerful. But I thought that was a good first step. There's an increasing awareness of the responsibility of the owners of the corporations to make sure they are run in the interest of shareholders and not in the interest of management and in the interest of building the traditional products and services that serve society, which is where all advantage comes from finally. And if you don't believe me, just read some of Adam Smith going back to 1776.
Let me just comment quickly on both parts of the question, the governance question and then the smart beta question. So, you know, with governance, I would say that there's a lot of empirical evidence that suggests that actually index managers are good governors, and they have to be, because an active manager, if they disagree with the company's policy or actions, can dump the stock. An index manager, by definition, is in there for the long haul. They will hold the company, and we've seen that they have applied thoughtful governance policies to actually affect change, to improve governance more generally at the corporate level, and that actually comes through in the data. With regard to the smart beta question, I think where you're going was, you know, is there herd mentality in smart beta? Are we crowding out certain factors? I'm not sure if that was the nature of the question, or if it was more related to governance.
More about companies changing their own behavior.
To reflect factors that are in vogue.
So you say quality is in fashion. Last year, you turned yourself into a higher quality company as a result to appeal and get a higher rating, those types of things.
Yeah, I think the factors are fundamental factors. I think it's difficult for corporations to alter their factor characteristics. So if you take momentum, I mean, that is a price market determined, you know, score, right? I mean, the company's either had rising stock prices in the last 12 months or it hasn't. It's difficult for a CEO to decide that they want to be a momentum play and to turn their stock into a momentum play. I think similarly, it's difficult to affect changes that turn a low-quality company into a high-quality company. But I'd say those, to the extent that ESG, you know, environmental social governance norms become more prevalent, and voters through the form of traditional index funds or through ETFs express a view for better governance, that may induce changes, you know, in variables that can be controlled at the corporate level. So.
Nick, could I add to that a second?
Sorry, Jack. Yeah.
Let me just say that there is how the smart beta funds perform and how their investors perform. And the data I showed you, that the funds haven't done anything out of the ordinary, and we shouldn't expect them to, and I don't think they will in the future. But how do the investors perform? And I will give you a quick, interesting anecdote. Morningstar now tabulates. They don't call it smart beta, they call it strategic beta. And they have a long list of funds. And 2 funds dominate the list. And believe it or not, I started both of them. I can't believe I started a smart beta fund about 25 years ago. And this is a very good example of the problem. And that is we started a growth index fund based on S&P 500 and a value index fund. And my idea was you would accumulate money in the growth index fund, have less taxable income, a little more volatility, and then when you got to retirement age, you would move over to the value index fund and have higher income and a little less volatility. Simple as that. And I said in the first annual report and the second and the third, I expect that growth and value will provide essentially the same return in the future, in the long run future. So 25 years is up. Both funds provided 9% annual returns, exactly the same. The investors in the value fund earned a return of 5%, and the investors in the growth fund earned a return of 5%. In other words, the investors' behavior was a big negative to performance. And any time you get something that is in the public light, in my opinion, and people start to follow it, that's where the pendulum that we heard about at the very beginning comes from. And that's what basically is a big detriment to the success of investors in capturing the market's return.
Thank you. There was another question. Yes.
Hi, I'm an alum of London Business School. My question is for either speaker, and I'd be interested in your perspective on the theme of replication in fixed income markets, be it via an index fund or through an ETF. And it's to do with two potential frictions you might have. One is the nature of fixed income markets from a primary perspective. So you have companies continually coming to market to either refinance or to issue new debt, or there can be debt that matures, but there may be a lag when it comes to deciding whether a passive vehicle will or will not participate. The second is in the secondary markets, where at the moment it seems that there is not yet widespread take-up of electronic execution, and therefore the OTC nature of these markets means that you will often see fixed income instruments quoted on, say, a one-by-one basis. A dealer will buy or sell 1 million, perhaps to work one behind, but they will not advertise what they might make as a price for, say, a 10 by 10, 20 by 20 market. And when you have vehicles that are very large in size, let's say a fixed income vehicle that grew so big in size, how would you handle liquidity requests in that fashion? Thank you.
Okay. Oh, Jack, do you mind if I go first?
Why don't you go first,
Yeah,
Ananth?
and Ananth, you go first.
Okay. Thank you. So just since I touched upon it in my slides, let me just say that, I think of actually fixed income ETFs as sort of a vision of what the bond market could be like. Trading on lit exchanges with a lot of, pre-trade transparency. You know what the quotes are. They're tight bid-offer quotes typically. You see the transactions after they're executed. This is a contrast to the way most bond market dealing currently happens, which is your question. Does it pose a challenge? Well, as I said, I think most of the trading in these bond ETFs is secondary market trading. So I said for the U.S. High yield bond fund, a stat is typically $6 is traded in the secondary market between buyers and sellers meeting on an organized exchange. Versus $1 in the underlying market. So it's a 6-to-1 stat, which is even higher in times of market stress. So I would say that, obviously the challenges of an opaque, and somewhat illiquid underlying market are always there in terms of how can you extend out basket trading to those kinds of markets. I mean, and Stan posed this question right at the beginning. I would say that right now ETF penetration is really tiny. We're a long way from any sort of semblance of indexing dominating these markets. And to the extent that we can move towards more equity-like constructs in the fixed income market, I would think of that as progress. The very fact that these bond portfolios trade on electronic markets may encourage the development of alternative trading systems in the underlying bond markets, which, frankly, I would love to see. We've done some research on that. And the benefits to investors, be they bond holders who are buying a bond and holding it to maturity, or ETF market makers, so on, is evident. The costs are typically lower. So I'll turn it over to Jack.
Yeah, maybe paraphrasing the question, Jack. Do you think bond ETFs can be bond index funds or bond ETFs can be as successful as equity index funds, or is there a natural limit to it?
Well, I like probably everything else, I started the first bond index fund back in '86, and it's been quite a remarkable success at the beginning. A little less so now with interest rates so very much lower. But we operate that fund. I think the Admiral shares are probably 8 basis points or something like that. Admiral meaning you have to have $10,000 at least on the fund. And we run all told, let me just guess, at about $400 billion of bond index assets or quasi-bond index assets. And understand that our strategy from the very beginning was to create not just a total bond market fund, but in the municipal area and in the corporate area too, and in the treasury area, but a long-term and a short-term and an intermediate term. So once you fix the term, and once you fix the quality, high quality, we don't do much in the low quality area, or intermediate quality, the difference between an actively managed bond index fund and an actively managed bond fund and a bond index fund with the same quality constraints and the same maturity constraints is going to be tiny. So what concerns me most, I went through a terrible liquidity crisis in 1987 with our municipal bond funds, just because some congressman said we ought to do away with the tax exemption. And we were selling bonds at big discounts. You have to have the discipline to do it because you need the money, but it was not a pleasant experience. So liquidity in the bond market, and particularly the municipal bond market, are going to make things very tough. I also have some deeply held reservations about the basic bond standard, the Bloomberg now Barclays Ag, the total bond market. This is in the U.S. now, of course. Most of my work is done with the U.S. And it's 70% Treasury, federal, and what I'll call good mortgage-backed, and 30% corporate, and it's intermediate in maturity. And I think that is not a sound policy, be quite blunt about it, for the average investor. The investor is looking for income, and the income, I mean, I guess the yield on that total bond market is probably, let me just guess, at 2.2%, something like that, after these measly 0.1% expenses. And so I think we need to think long and hard about what the essential middle-of-the-road typical index position is for a human being who probably would not say, yes, I want 70% federal and only 30% corporate. He might say quite the reverse. And I would say quite the reverse. At least for me, what do I know? But for my personal account. So I work around that by mixing our various bond funds in my portfolio, using more corporates and a more intermediate term as compared to total market. So there's a lot to be done in the bond market. I do think in the long run, bond indexing is going to be just as competitive as stock indexing because the bond returns are so constrained by the interest rate yield when you buy the bond that if you can come in with a lower cost, maybe we can get that down to 5 basis points, and the competitor's charging 65, you're going to see indexing burgeon in bonds. I think it's going to take probably 3/4 of a decade, but it'll happen.
Yeah, I just want to jump in. I totally agree with that comment. I would say that Jack raises two very important points. One is that the art of index construction is exactly that. It is an art. So when the Lehman Ag was first introduced, it was an innovation. The idea of a broad market index for bonds, when it was introduced, was actually quite novel. And people said you couldn't do it. You couldn't bring equity concepts like market capitalization weighting to the bond market. Or you'd make a mistake because you'd overweight states or municipalities or countries that issued a lot of debt, and that would be the wrong answer. I think we've moved on beyond that, but there's clearly a lot of art in the construction of a fixed income index, and I do agree with Jack that we have quite a bit of room to grow in terms of the art. The second point that Jack made, and he touched upon, it was close to a point that I've made, which is every investor is different. So Jack has a different perspective than, say, I do on buying the ag. And he can mix and match. And actually, ETFs give him the choice to do that. If he wants to reverse the ag weightings in mortgages and government bonds, he can do that. He can actually buy 2 ETFs and get exactly the ratio he wants. That's the choice that I think is so important. So I think those are the two most important comments for the development of the fixed income markets.
Okay. I'm conscious of time. Do we have time for one more question? I'm looking at the powers that be here. Yes, one more question. The last one. May it be a good one.
I'll try it. Do you think that the focus we have right now on data science, artificial intelligence, will lead again to a whole creation of new product? And do you think some of that will potentially look at taking a view where there's a level of certainty of what index funds and ETFs do, and potentially create product that potentially actually takes some return away from that?
Jack or Ananth?
All right, let me take a stab at that, and we'll let Jack have the final word. So, you know, I think we've been through this cycle actually before. Years and years ago, it was neural networks, and now it's big data and machine learning and textual analysis. And I would say all of these are tools, they're elements of the toolkit, typically for active managers, to extract alpha. And it's partly an arms race. So years and years ago, you were actually ahead of the curve if you could digitize the earnings announcements or the dividend announcements ahead of the rest of the pack that were still doing it with paper. And that's all become more advanced, and we've seen more intraday trading and more use of analytics, machine reading of tweets, all the rest of it. I think it helps alpha managers if you're trying to actually come up with a better, you know, if your target is to beat a benchmark, then obviously you want to be adopting these techniques, because that is in some sense part of the arsenal. It's not the only part, but it is part of the arsenal. I would say for index managers, I'd include traditional index funds as well as ETFs in this. You know, our job is much simpler. We're not trying to beat a benchmark. We're trying to exactly replicate a benchmark. And, you know, that knowledge of what's going on in social media, the ability to read text helps us manage risk. It helps us control you know, or predict flows a little better. It's useful to us, but it's not a panacea. So I'll let Jack have the final word.
Well, maybe I've been around too long, but you know, in one of my books written back in 1999, I examined quantitative investing, just really coming into its own then. And I concluded, which pretty much is what I would conclude today on these issues, which I'll come back to in 1 second, that there was no reason to expect quantitative managers as a group to beat the traditional actively managed security analysts. They zero out. And the quantitative managers could win because they should have lower costs. They don't have to hire anybody. But other than that, they should be identical. And that's really pretty much the way it has worked out, just as it should. So when you get to artificial intelligence, whatever else it might be, big data, I think in a very, very short time, if not pretty much immediately, whatever that innovation is, gets arbitraged away very quickly. I mean, if you can patent it, I suppose that would mean something, but no one in this industry has been able to do that yet, and I don't see that that's a patentable idea. So I think beware of any strategy that is designed to beat the market over 50 years. And I just wouldn't do it. Why take the risk when the market return is there for the taking?
With those final words of wisdom, I would like to ask you to join me to thank the speakers for their insights.